Right. Yeah, morning all. Yeah, interesting moves last week. Gosh. No, not a Santa rally. Everyone calls it when it rallies in December, it's called a Santa rally. A Santa rally is when the markets rally literally in the 2 or 3 days before Christmas. So towards the end of this week, and actually in between Christmas and the New Year as well. That is also when you can get a Santa rally. Um, anyway, it's not a Santa rally. We're not experiencing anything like that. We are um, experiencing quite uh, a rebound, or not a rebound, a surge following these central bank meetings, which is extraordinary. Anyway, so last week, yeah, great week for stocks, although not brilliant here in the UK. We surged and then we reversed the moves, didn't we? Just looking at the FTSE 100, you can see here this massive up candle, and then it all petered out on Thursday, and then Friday it completely reversed it. Yeah, I think years Santa's bag is empty this year. Well, Santa's bag might be empty, but most people are now sort of positioned globally with regards to their investments. Gone are the days when we'd be sort of here in the UK focused on UK markets. So, when you look at the S&P 500, that's not a bad move. You look at the Dow Jones, that's not bad. And the Nasdaq, well, goes without saying, that's not bad. DAX, less so, running out of steam, but better than the UK because DAX very much is sort of technology based and tracks what the Nasdaq tends to do. But as I say, here in the UK, yeah, it's a tough old road, isn't it? But we've improved. We've improved since the end of October. Absolutely, we have. Touching 7,800 last week or on the way to it. So, yeah, Santa's bag is a bit empty, but just for the record, US indices extended their gains last week, so I'll put the S&P 500 chart for us to look at, and the S&P, you can see that it achieved what 1, 2, 3, 4, 5, 6, 7 consecutive days of gains on Friday, and we're so far up today as well. It touched its highest level since the 10th of January 2022, and it's now within 2%. Yes, 2% of the all-time highs achieved on the 4th of January 2022. I just wonder how many of us, I wonder how many analysts predicted this time last year, with inflation out of hand, with interest rates rising inexorably, that our markets would perform, or some markets would perform as well as they have done. Just the most extraordinary outcome. Anyway, for the record, the weekly change, FTSE was only up 12 points in the end with that big reversal on Friday. The DAX actually ended up closing down 60 odd points on the week last week. But the US markets, as I said, the Dow, gosh, that's over 1,000 points higher, 3% on the Dow. The S&P 500, that was up 100 points, which is about 2%, just above 2%. And that very volatile and particularly strong Nasdaq up 540, which is 3.5%, just extraordinary. Yeah, Paul, I'm hoping to do the year end of year review, but we'll be discussing that this time next week as to the timing of that. But yeah, it's there weren't many people who predicted this, put it that way. That is for sure. Then the Nikkei, that's all in a bit of a cross hairs at the moment, with the Bank of Japan meeting tomorrow, well, early tomorrow morning. So the Bank of Japan's Monetary Policy Committee meeting, and actually the Nikkei has fallen in line with the yen rallying. And when you look at the Japanese yen here, this is the Japanese yen has been rallying versus the dollar, having punched above that psychological 150 level. Gosh, we're back down at 142. And the yen last week, I think, gosh, it gained a couple of yen on the dollar in the week, which is a very strong move. No, actually, nearly 3 yen on the dollar. Yeah. Anyway, let's have a quick look. Reasons. So 3 monetary policy committees met to deliberate on interest rates last week. In fact, 4. think including the Swiss National Bank. Anyway, the key ones were the Federal Reserve, that's the US Central Bank, and their rate setting committee. It's called the FOMC, just in case you're wondering what FOMC stood for, Federal Open Market Committee. Here in the UK, we've got our own Monetary Policy Committee. They set rates for the Bank of England. And then you've got the European Central Bank. Theirs is called the ECB Governing Council. So, and they set what's called the main refinancing rate. Anyway, they all came to the same decision. They kept rates unchanged, but the outlook or guidance provided by those making these key interest rate decisions really did differ. The US Central Bank, the Federal Reserve, and its rate setting committee did what was expected of them and kept rates on hold. So when we look at what rates are, they're currently 5.25% to 5.5% band. This was never in doubt, with the market projecting it at a near certain outcome. Anyway, that's now been removed from this forward rate tool because it's gone, it's been done. Anyway, what was pleasing for the markets was the guidance and comments provided by the FOMC statement and also underlined in the press conference that followed the meeting. So if you remember, there's they have a press conference which is half an hour after the announcement and the release of the FOMC statement. So, yeah, for the past month, I think the markets have been at odds with the rate setters. We often look at this FedWatch tool here and we think, yeah, interest rates are going to go down. Yeah, but the Federal Reserve is saying they're not going to be cutting rates until Q3 next year. And yet Jerry's been showing me in May next year that rates are going to be cut from 5.25% to 5%. What's all that about? Why would the market think differently to what the people who actually set the rates are saying? Anyway, that often happens though, and it doesn't mean that the forward markets are wrong, and it doesn't mean that the rate setters are wrong, because the rate setters are only wrong when we actually get to that date. So the opinion will ebb and flow throughout the next sort of 5 months until May next year for that rate decision to happen. But you'll already note that even in March now, there is a high probability now that rates will be cut then. Just extraordinary in a way how the market expectations with forward rates seems to be leading the Federal Reserve. But in a way, the Federal Reserve only get to comment every month. And in fact, they don't comment again until the 31st of January and then the 20th of March. Whereas the market is speaking every minute of the day. It is telling us literally from 1 minute to the next what interest rates are going to be. Yeah. And that's why we look at this particular tool. It's called the CME, Chicago Mercantile Exchange FedWatch tool, and it basically gives a graphical illustration of what the forward interest rate contracts are saying about future rate rises. So anyway, we were predicting that rates would be cut by next May. It looks like we're getting primed for a global recession in 24. You see, this is interesting, really interesting you say that, Owen. I wonder actually whether we will get a big recession, a global recession. Is China likely to really implode any more than it has done? Is Japan not going to keep on recovering? In fact, the data out of Japan's not good. I think there's going to be a soft landing in the US. Will there be a global recession? Yeah, it's not looking good in the Eurozone. But ironically, one of the stronger economies at the moment is the UK. Just extraordinary. Yeah, China debt and US debt will lead the way. Well, we had so many opinions about it this time last year, and none of those have come to pass. I do wonder, but I think it's going to be a trickier year for stocks because equities spent most of this year looking forward and predicting an end to the interest rate raising cycle, which is effectively what has happened. And now they've already factored in the rate cuts. So remember, markets look forward up to 15 months. And the question is, is that bullishness displayed in the current price is going to be borne out by future events? That's really the question we need to ask ourselves. Anyway, the markets were at odds with the rate setters because the market's expecting rates to be cut in May, possibly in March, but with the rate setters saying that no, it's not going to happen until Q3 next year. Well, this all changed on Wednesday when the FOMC made their announcement, and this was what happened last Wednesday at 7 o'clock in the evening, and it said that, and the shock was that the Fed said that it was likely that they will be cutting rates in the second quarter next year. Jay Powell, the chairman of the Federal Reserve, said that the target rate was likely at or near its peak for this tightening cycle, which is what we've all been saying, which economists have been saying. But he's the person and his committee, the people that actually sets the rate. So he has added responsibility. I can say 1 month or 1 day I think rates are going to come down, and the next week I can say, well, then I don't think they're going to go down anymore, and it doesn't matter. But what matters is what the committee think and what they do and say. Anyway, so they've said that it's likely that the tightening cycle has been concluded. Not only did the FOMC state that it would be cutting rates next year, they've got this thing called the dot plot. And this dot plot is where all the committee members of the Federal Open Market Committee report where they think interest rates will be on quarter by quarter basis for the next 2 years. And it's really interesting to see how that graphical illustration has shifted. So by the end of 2024, the committee members of the FOMC expect rates to be at 4.5 to 4.75%. That's the end of next year. What I would like to show you is at the end of next year, this is what the markets are now saying, 3.75. So another 0.75% lower than what the Federal Reserve Committee members are saying, and that's them having cut their forecast as well. But it seems that every time the rate setters shift their opinion, the market shifts it even further. And by the end of 2025, the committee reckons that rates will be at 3.5 to 3.75%. I can't show you on here. The forward rates only go out to a year forward, just on this particular FedWatch tool. But there are forward rates that can show you that in 2025 the rates come even lower than this. Anyway, so this softening in interest rate outlook or dovishness caused US stock indices to jump. And we've been looking at them. We can see exactly that in the S&P 500. Maybe it's a ploy for election year. Yeah, I don't get it all really. But in a way, Owen, when we look at the markets, what's caused the Nasdaq and what's caused the S&P to rally? Some clever wag now refers to the S&P 500 as the S&P 493 and excludes the Magnificent Seven, which are the reason for the market's rally. If you deduct the Magnificent Seven, the S&P 500 is unchanged. The gains this year of 40% are down to 7 stocks that have created trillions of dollars in value. Just extraordinary. More value than the entire valuation of the UK stock market. Yeah, extraordinary. A lot more, I'd say. Anyway, so this softening in interest rate outlook caused, I think it was a 1.3% jump on Wednesday when the news came out. I was looking at the hourly chart. Anyway, I think it was 1.3%. So on Wednesday evening at 7 o'clock, by the time the market closed at 9 o'clock, the stocks had jumped 1.3% just on the back of that news. And it was a move that, as you can see, persisted through Thursday and Friday and is persisting today. Yeah. So what about the European Central Bank and our own Monetary Policy Committee here in the UK? They also delivered their final policy decision of the year. So our own Monetary Policy Committee, or MPC, that's the rate setting committee for the Bank of England, agreed to keep rates unchanged at 5.25%. We all know about that because it's well publicised by the BBC and all the other media outlets here. And the voting intentions were sort of as expected, nothing too much to worry about, although 3 did vote for a rate rise, but a majority definitely on hold. But what was interesting is, unlike their US counterparts, the European Central Bank and the Monetary Policy Committee rate setters were a bit more downbeat, actually, about the prospects for rate cuts in 2024. Christine Lagarde, who's the chair of the European Central Bank, was more cautious. She said that there's still more work to be done bringing inflation under control, whilst Andrew Bailey from the Bank of England, he's the governor of the Bank of England, said there was some way to go in the UK in bringing inflation down to the target. And I think the MPC reaffirmed its view that interest rates would have to be kept elevated for an extended period of time, and also left the option open for further rate rises. So there is a definite difference between both the MPC and the European Central Bank compared to the FOMC in the United States. And this more cautious approach to potential rate cuts caused markets to stall. And that's one of the reasons why you only saw modest gains in US markets. And when you look at FTSE, yeah, look at that, bang, right back down again. We're back up again this morning, but it's not the sort of lift off, starship move that you're seeing in the US, and even Germany. The DAX is looking decidedly wary at the moment. Anyway, and I think in the UK, I think it's probably more understandable why Andrew Bailey was more cautious. We had predictions from the Office of Budget Responsibility that inflation would only fall to 2.8% by the end of 24, and hit the target rate as late as mid-25. So that's the target that the Bank of England has set itself of 2%. But the Bank of England actually is more bearish than the OBR. The bank predicting that inflation will still be at 3.4% by the end of 24 and 2.2% by the end of 25. So inflation's always been a bit more of a problem in the UK than in other developed countries, and so it appears that core inflation is notably more sticky here in the UK than in the Eurozone and in the US, and that's one of the reasons why you're getting comments from the Monetary Policy Committee and Andrew Bailey that just appear at odds with what's happening in the US. Yeah, it's interesting because bond markets as well. Can I get bond markets? Yeah. So these are the bond markets. Let me just show you the US first. So we've got 3 lines on this graph. It's a neat way of showing you the yield curve. This is the yield on various durations from 1 month, 3 months, 6 months to 2 years, all the way out to 30 years. And the ones we're interested in are typically the 10-year, which are the main bond markets. And you can see in the US that the 10-year bond yield has fallen to 3.91% from 4.49% a month ago. And it's been falling not just for a month, but for 2 or 3 months. What does this mean? Do bond yields matter? What are bond yields? This is the yield or the return that you get investing in a bond, a treasury bond. This is the US sovereign bond, so issued by the US government. You'll get 3.91% per year for 10 years. Yeah, that's it. It is, however, what corporate bonds latch on to as well. So corporate bonds have a spread greater than sovereign bonds. So when bond yields, treasury bond yields fall, so do corporate bond yields. Why does that matter? It basically means that companies can raise more funding at a cheaper level. In effect, this is a loosening in monetary policy. Yeah, a loosening in monetary policy. Same thing in the Eurozone. Look in the Eurozone, where Christine Lagarde is saying, well, we're not going to be cutting rates possibly next year, but look what's happened with bond yields. Bond yields are predicting that rates will be cut. 2.21%, sorry, At 2.02% on the 10-year, it was 2.59% a month ago. Really interesting. Really, really interesting. Anyway, so despite the guards warning that there was still work to be done in raising rates or keeping rates elevated, bond yields sank last week. And I think that basically means investors believe that the struggling Eurozone economy will result in rate cuts as early as the second quarter next year. Yep, second quarter. Yeah, and what was also interesting is when we look at the data last week, this manufacturing data, this is dire. Manufacturing PMI 44.2, services 48.1. This results in something called a composite index. So the flash composite PMI data for the Eurozone, 47 from 47.6, below consensus and well below the 50 level that marks contraction versus expansion in activity in the Eurozone. Yeah, as Owen has just said, the EU is struggling. But actually contrast that with the PMI data out from the UK. And you might be saying, well, hang on a second, our manufacturing is right, 46.4, but our service sector, which is by far and away our biggest sector, greater than 80% of our economy is down to services, a greater percentage than in any other developed economy, greater than in the Eurozone, greater than in the US. So when you see the service PMI jumping, it actually pushed the composite PMI index up to 52.7 here in the UK from 50.9. It's a bit stronger than 47 in the Eurozone, well ahead of consensus. And it really just surprised everyone. And I think anyone who was thinking that the UK was a basket case of an economy at the beginning of this year, and the press loved to somehow almost revel in our misfortune. And there's been, as I keep on saying this, but I find our press just so frustrating. Anyway, Andrew Bailey may be right about being cautious about interest rates, because unfortunately, the double-edged sword is that you can't have a strong economy and expect interest rates to fall. That's it. Very quickly on to foreign exchange rates. We all know that the US dollar lost ground last week in a knee-jerk reaction to the Fed's dovishness over rates. The projection on future rate moves now has the FOMC predicted to cut rates by as early as March next year, as we've just been looking at. UK forward rates are not as dovish, hence sterling's relative strength when you look at it against the euro, for example, one of its main trading partners. So sterling quite strong there and quite strong against the dollar. That's down to the fact that rates won't be able to be cut as much as in the US and in the Eurozone, although Christine Lagarde doesn't think so. But I think analysts are torn between the very strong data we had on Friday and also evidence from other developed economies that are expecting to cut rates. Erudite, Sean, you're very kind. Erudite, try spelling that early in the morning, but you're very kind. The Japanese yen jumped ahead of the Bank of Japan's monetary policy meeting this week. Quickly have a look at the yen. Where's the yen? There we go. Gosh, yeah, look at it. We were above 150. I did remember looking at that and thinking, it's not got the legs here. It's not going to hold above 150. But Japan hasn't really suffered the ravages of inflation over the past 24 months like other developed economies, and the Bank of Japan is sort of presented with a different set of conditions to deal with. I think analysts are pretty certain that the bank's going to maintain their current policy of negative interest rates. I think that's what tomorrow morning, as we said, but we'll get onto that in a second. But analysts are warning against any rush to raise rates, and a lot of the data coming out of Japan now is starting to look a little bit nasty. So, but I'm surprised at this strength in the yen. But let's probably worth revisiting when you get up tomorrow morning, because you'll then have the results of the BOJ rate decision. Lastly, commodities, gold. Well, we know that gold is tracking the US dollar. That softened last week, as you've just been discussing about the Fed's dovish comments. The outlook for the dollar versus the majors, I don't think is that certain, because it's pretty clear to me that other developed economies will surely follow the Fed into cutting rates in the second and third quarter next year. So I'm not sure that the US dollar will remain as weak as perhaps some analysts are saying. Right. Oh, yes, and oil. I've had a few calls about oil. Oil recovered some of its losses over the last, ever since really sort of early October. Largely on the back of profit taking. The gains were last week. The IEA, the International Energy Administration, put out a report about the OPEC Plus cartel, saying that the cartel now controls less than half the oil market, which is the lowest level since the new OPEC Plus, which includes Russia, was formed in 2016. Not something that those members of OPEC Plus, you could say greedy members, you know my view of a cartel. It's illegal, it shouldn't be operating, and it's spurious reasons why they say they're doing it for the good of the global economy. Whatever they're doing it for, it's not working in their interest, as OPEC Plus is losing market share and sustaining falls at the same time in the price of crude. So, and that is sort of reinforces the view that the OPEC Plus members will disagree more in the months to come about production cuts, because those production cuts have only been replaced by non-OPEC producers producing more, notably in the US. Yeah. Right. The calendar for this week. Let's get on to the right week. The final week before Christmas. Christmas has fallen on Monday and Tuesday, so we get Christmas Day, Boxing Day here in the UK off next Monday and Tuesday, and then we're all back at work Wednesday, Thursday, Friday, regular 3 days. And likewise this week. In the US, they take no, they don't. No, because it falls on a Monday. I was going to say this is a regular week for all markets actually, so there are no holidays this week, and we just get Saturday, Sunday, Monday, Tuesday off, and then we're all back at it on Wednesday. Although the US get back to work on Tuesday, they don't take bank holiday off. Right, so we start the week with this German IFO business climate, and I had written in my notes, struggling, wouldn't be surprised if it misses. Well, it's missed. 86.4. It is not good news in Germany. It's highly likely that Germany is in a recession. It's struggling with one of its major export markets, China, just going into a bit of a tailspin. The reliance on Russian energy, the spike in energy prices have really hit German industry badly. Anyway, the whole thing looks pretty gloomy still, and this is another miss here. And there's no clear uptrend at all in the business climate, and not surprisingly so. Bank of Japan's monetary policy meeting happens overnight tonight. You're going to wake up in the morning and find out that the Bank of Japan has likely kept rates on hold at minus 0.1%, so negative. And there may be a change to the yield curve control. But I think analysts are now more convinced that the Bank of Japan should not be rushing to raise rates at all, having said that they should previously, but now the data is starting to paint a pretty bad, poor picture of the economy for now. We then jumped to, okay, so this loan rate, the prime rate, this is the 1 and 5 year rates. Everyone knows that the People's Bank of China, PBOC, can't afford to lower rates, although they would like to, but it would only pour oil on troubled waters in the property and house building sector. So that's just a non-starter. Here in the UK, we've got inflation data. It's funny, our inflation data came out the same week a month ago, but the US inflation data came out last week. So it sort of ebbs and flows, but we've got our inflation data out this week. Yeah, 4.3%. We are falling again. The core inflation, though, is not expected to fall as much. I haven't actually got that data to hand, but I do know that it's expected not to fall as much. But the headline rate is still something that a lot of people still focus on, and the difference between headline and core inflation is the headline one includes the volatile components, which were the reason why inflation went up to 11.1% in the first place. But we do know that inflation is stickier here in the UK, so it's the core inflation that we'll want to focus on when that data comes out on Wednesday morning. Conference boards, consumer confidence out at 3 o'clock on Wednesday afternoon in the US. These are the bits of data we like. We keep on talking about consumer sentiment. It's a great leading indicator. We used to get actually leading a release called the leading indicators, but now we don't need that leading indicator index because we track all the separate releases independently. But we do know, I know, that consumer confidence is something that is key. It's key for future prosperity. Happy consumer, happy spenders, but they're not that happy in the fourth quarter this year, the consumer, but we're expected to see an uptick in confidence there. We then jump to Thursday. We have what's called the final reading of the third quarter GDP. This is the least important one. It's what's called the advanced reading comes first, then the prelim one, rather confusingly, and then the final. It's unusual for the final reading to be adjusted, but we're expecting an unchanged rate of 5.2%. What a tear that US economy was on in the third quarter, though. Just extraordinary when you look at what's happening here in Europe and in the UK. Philly Manufacturing Index. So this is one of the two big manufacturing regions in the States. There's the Empire State, which is basically New York, and the Philly Fed Manufacturing Index. Slight improvement. You get the feeling that manufacturing is starting to just stir a little bit, but it's still pretty poor, below the zero rate. Friday, we finished the week here in the UK with our retail sales data. Bit of a horrendous number last month, but according to PMI data we saw last Friday, things are definitely picking up. That was such a strong number. We've got to be seeing stronger data coming out of the UK, which is not something that is going to be a particularly Happy New Year present for the Monetary Policy Committee as they grapple with probably what will look like sticky inflation coming out of the UK. And then in the US, we've got durable goods orders. So this is used to be a really important reading, actually. Oh, sorry. Yeah, and the PCE price index. Sorry, got to focus on that as well. That's the personal consumption expenditure. This is a sort of a measure of inflation, and it's the one that the Federal Reserve use more than the actual CPI reading. So that's something that will attract a bit of attention at 1:30 on Friday afternoon. We've also got durable goods order. This used to include, well, actually the headline rate includes very big transportation items, and they tend to exclude transportation items such as cars and aeroplanes. But the core durable goods reading plus 0.1%. Yeah, that's nothing to write home about. And then the revised University of Michigan consumer sentiment reading. I've never seen a revision actually, and I've just noticed this week that they're predicting a revision from 69.4 to 69.5. Anyway, we like to see happy consumers, as I keep saying. That's it. Yeah, thank you very much. Yeah, Merry Christmas to you, Owen. Henrietta, can you please check with your coach, please, on that one? If not, call customer support and they can help you. That'll be great. Thank you very much. Yeah, listen, have a happy Christmas. This time next week, we're definitely not having a session. We will confirm when we're having our final sort of review of the year, which will probably be on probably Thursday morning, which is Thursday. I know why we hadn't agreed on it, because I think our offices, which I'm going to have to do it from home. But anyway, it'll be on, I think it's going to be on the 28th, but you will have that confirmed in in the members area. Yeah, listen, yeah, have a happy Christmas. I hope it all goes well. Just relax, chillax, and do what you love doing. Um, yeah, probably sitting, eating 6,000 calories apparently we each consume on Christmas Day. It's frightening, isn't it? Thank you so much. All the best, and catch you again in between Christmas and New Year if you're around. If you've had too much Christmas, come and join in. Thanks very much. Bye for now.